Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. I have with us today a very special guest. His name is Scott Carson. He's an active real estate investor and entrepreneur since 2002, focusing on the niche of distressed mortgage notes. Since 2008, he has purchased over $1 billion in distressed notes on residential and commercial properties all across the country. He has helped thousands of real estate investors and entrepreneurs create wealth through his debt buying tactics and classes helping his students close thousands of deals. He also hosts a nationally syndicated radio and podcast, Note Closers Show podcast, with millions of listeners each month. An avid sports fan, he spends his free time traveling, gardening, and making memories. He calls Austin, Texas home with his better half, Stephanie, and his four kids. Scott, welcome.
Four-legged kids. I don't have
Four-legged
kids. Four-legged kids.
Well, welcome to the show, Scott.
Hey, Zay. Honored to be here today. Thanks for having me.
Yeah, thank you. I'm excited you're with us. I love what you do in that no investing. I think it aligns really well with kind of the principles of the show of like you're thinking like a bank. You're not just going out and actively purchasing real estate. You're more so on the back end dealing with the notes, kind of like what banks use, what banks do. Before we jump into that, tell us a little bit more about your background and how you got into this special niche.
Yeah, it's definitely a niche within the greater real estate niche, I guess you could say. I'm just one of a few guys, a few people in the country that actually teaches this niche investing, but I've been doing it for over 15 years now. It's hard to believe that. But previously, I was a financial advisor. Actually worked with Citibank and Smith Barney back in the day, but got out of that when they closed their office down here in Austin, Texas, and kind of did a few different things, but ended up getting back into banking. Actually, was a mortgage banker for Bank One and JP Morgan Chase. Did that for a couple of years, was a top banker. And then a buddy of mine started a mortgage company back in 2004. So I left banking to actually originate loans and had the good fortune for about 4 years to travel the country, working with investors of all sizes, big and small, learning a lot of creative real estate investing strategies out there. And had the good fortune for basically have a 4-year apprenticeship with one of the top investors and another top marketing mind in the world out there. And when everything hit the fan in 2008, they told me, like, listen, it's instead of originating, it's time to start buying this bad debt. It's we hadn't seen the likes of what happened in 2008, 9, 10 since the savings and trust scandals during the Resolution Trust Corporation day. So I sold my half of the mortgage company for $1, and instead of calling banks to see what type of loans or mortgage companies, see what kind of loans that they were originating, I was calling to see what kind of bad debt they had, what kind of loans that they had in their books that the borrowers had defaulted on, not just subprime borrowers, but also a paper borrowers out there, and literally dialing for dollars, making 50 to 100 phone calls a day. I felt like Will Smith from The Pursuit of Happiness a lot of times, a little bit like a boiler room kind of thing too.
Yes.
And, fast forward now since 2008, I've been the Note Educator of the Year once and runner up twice or two, helped thousands of real estate investors tap in the world of becoming the bank and buying the debt direct from the banks at a big discount. And then working really to kind of work with the existing borrowers in place through modifications, forbearance agreements, deed and lieu, cash for keys, short sales, reduced payoffs. There's a whole variety of different strategies. But that's kind of what I've been known across the country as the Note guy, because we do market a ton on YouTube and video, and we have the podcast, the Note Closure Show as well too. But that's kind of a little bit of a nutshell. I mean, I've bought debt in just about every type of asset class you could think of, and really we get the biggest bang for the buck as an investor, actually working to keep people in their houses. Most people that are in real estate, they're used to the AG or A&E TV or HGTV, you flip this house or flip or flop. I'm not a big fan of those fictional TV shows for the most part, because they don't show it exactly what it is. So we work to buy that debt from banks, and then I'm buying primarily debt where the borrowers are in the house still. Haven't paid in usually 6 months or greater, 6 months to 6 years. And we make our money by actually working, as I like to say, to make America great again, one defaulted borrower at a time.
Awesome. So essentially investing in notes or buying notes pretty much means that they're in default right now with their lender, and then you're going in and you're stepping in and you're buying that bad debt from the bank.
Yeah, definitely. I mean, borrower still owes what they owe.
Yeah.
It's just that the banks and lending institutions would rather sell that debt off at a discount,
Yes.
get that money back in, and then turn around and rinse and repeat it. You
Yes.
may have heard the velocity of capital.
Yes, of course.
And depend on what's going on with the borrower, depend on what state it's in, how far along the foreclosure process is, or how the bank's portfolio looks like.
Yes.
Some people ask me, well, why would the bank sell at a discount and just work it out themselves? Well, they try to work it out, but sometimes they can't, or they're more focused on better assets or bigger assets, as far as balances or asset class. And so they often sell a lot of their smaller balance stuff off to funds or investors like me.
So what if, for example, like, let's just say there's a house, the market value is like $500,000. The person living in it has already paid off like half of it. So they have $250 in equity, or they paid down to the balance of $250,000, but now they're in default and it's been about 6 months. How much would you typically pay for something like this to take?
See, I wouldn't go after that because there's all that equity. Yeah. So they're not really in default. I mean, they are because they haven't paid. But with all that equity above what's owed, the bank's not going to take a big discount on that note.
Okay, gotcha.
And the buyer can, if the bank forecloses, they're for sure going to get paid in full at the foreclosure auction. Yes. Because most properties are selling at 60, 70, 80, 90 cents at the foreclosure auction.
Yes.
So let's flip the numbers. Let's say that their house is worth 400, but they owe 500. Okay. They haven't paid the last year because of COVID or everything else, or then they get defaults and stuff like that. Now that's something I would chase, something where they owe more than the property's worth, because first and foremost, there's no equity there. The borrowers aren't going to fight you because they're upside down. They know they're upside down. Yeah. If there is equity, the borrower's going to fight you. They're going to drag out the foreclosure process. I mean, we're dealing with that with a couple cases right now. So we have much more flexibility, and plus the bank is now motivated to sell a bit more because whoever wrote the loan for buying direct from the originator, they're upside down on it. It's not worth what the paper it's written on, right? So on something like that, we would come in and offer somewhere between 50 cents on the dollar of market value and work our way up from there. And I wouldn't go above 70%. So I'd pay somewhere between 200 and 280 for that.
Okay. And then you would become the lender then?
I become the bank. And then we'd reach out to the borrower, see what's going on. I mean, we would know a lot what was going on with the borrower beforehand because we have a lot of due diligence. We're able to talk with the lender is going to share with us the servicing notes if the borrower's been responsive in calling in or told the banker, whoever's called them to go, pound sand. We're going to look at the collateral file, seeing what's going on, if there have been any hardship documents filed or other servicing notes. We're going to look at the property value itself. We're not going to be able to get inside because somebody's living in the property. We can still tell a lot about that borrower by the exterior view. Is it in good shape? Is there some emotional equity like kid toys, landscaping, flag out on the mast, stuff like that. And then of course we do a little bit of social sleuthing by jumping on Facebook and LinkedIn and other things and seeing if the borrower's on there, what they're sharing, what they're not sharing, and go on there. You got to realize we literally get the whole loan file before and get that to view before we ever end up bidding, so we can see, what happened, what were they doing when they originated the loan, and then we can often tell online, by verification of employment and making a few phone calls to see if they're still working or not working. And that gives us a good idea if they're going to be a good borrower or they're going to be a borrower that's not helpful. If existing banks already started the foreclosure process, we usually know that they've exhausted a lot of their, borrower outreach. And, that doesn't mean we haven't had borrowers come to the table and we've modified. It also doesn't mean we haven't had borrowers that we thought we would modify who ended up going to foreclosure because they just went silent on us.
Okay, I see that. So you would then stay as the lender, like for how long? How long would you stay as a lender then?
It depends. If we're going to foreclose, then we, if it's 6 to 12 months to foreclose, we're the lender, and then we foreclose and either sell the property at the auction. So back to our case study, if we bought it at 280, and we sell it at the auction somewhere at 90 cents on the dollar, so somewhere between 360 and 400,000. So we'd make our profit of 100, 120, 130,000 between what we bought the debt for and what the value of the property is. But let's say they hadn't started foreclosure when we bought it, we would try to reach the borrower to get them to modify, reinstate, do a forbearance agreement, and then that's what we like better, because if we get them paying in 90 days, we're only at 280, so it gives us a lot more flexibility in the bank that financed it at 500. You know what I mean? So it gives us a lot of flexibility to incentivize the borrower. Like, listen, I know you're upside down. Hey, start making your existing payments every month now. Can you reinstate that? Can you pay a little bit extra? You haven't made a payment in 12 or 24 months. You get your tax return in, or you got some money you can bring, a couple months to the table. And then for every $100 extra you pay, we'll forgive $200. Or if you'll pay on time for 12 months and make a little bit extra at the end of 12 months, we'll forgive what you're upside down on and readjust the balance. And so with a performing note, we have less outgoing because we're not paying attorney fees or foreclosure costs if we have to foreclose, or repair costs if we need that. We immediately start getting the borrower to pay on time. And then if they pay on time for 12 months, it's considered a re-performing note. Mm-hmm. And then we could sell that note back to the secondary market for 80, 90 cents on the dollar without having to foreclose, without having to do any heavy lifting or anything. So we've got cash flow along the way, a big paycheck on the back end. We also get some money on the front end by having the borrower bring some skin to the table to stay in their house.
Okay, so it's really like if it's a good deal to start with, really it doesn't really matter which way they go, whether they pay or they foreclose on. You're still kind of making money in either direction.
I call it kind of a choose your own adventure. and if it takes a while to foreclose, but we also, if a borrower can't, we really want to work with them. If they can't stay, well, do they have somebody that can take over payments, or let's list it? And we'll be glad to, approve a short sale. If it's worth 400, let's list and get it sold for 390 or 380 and make it a win-win and not come after them for any deficiency judgments, or we won't report any late pays. But if they won't work with us, then we'll take it to the full extent of the foreclosure. But we'll even give them cash to walk. Hey, you can't pay your existing payment, you need to move out, or you've gone through divorce or something where you don't have both incomes from family members or something like that. So, hey, let's give you a couple grand to walk, because if it goes through a foreclosure, it's going to affect your credit derogatorily for 7 years. Late pays will just be 2 years, and you can be back in a better situation.
So what's the deal now with COVID? Like, what's going on with that? Like, as far as foreclosures are going and things like that. Talk to us more about that.
Yeah, so it's been a bit of an interesting time in the last 18 months, but now that the foreclosure and eviction moratoriums are pretty much over across the country. Every state's a little bit different. I mean, Texas, we've been foreclosing since April. Wow. Vegas won't start foreclosures till January. They just made it mandatory. They won't do. So you've got to know what's going on in that market.
Yes. Mm-hmm.
That leads to, with it being the fourth quarter, I don't know when this can come up, but the fourth quarter is always our busiest time. And the first quarter is the second busiest, because banks are looking to get bad stuff off their books at the end of the year.
Okay.
And so we're seeing more portfolios coming in. We're seeing more defaults, especially now that the eviction and foreclosure moratoriums have ended. We can actually proceed if the borrowers aren't performing. And so it leads to a lot of stuff. We were pretty lucky. We had most of our portfolio, the borrowers kept paying on time along the way. We gave a few forbearance agreements for 90 to 120 days. Of course, you're always going to have those bad apples that take an inch and try to get a mile out of it.
Yeah.
And that's going to happen. I mean, but for the most part, there are other options for borrowers out there. I mean, there's a lot of different funds and third-party organizations. I mean, there's $49 billion in funds allocated by the government to try to help people stay in their houses through either eviction help or foreclosure help and stuff like that. But obviously, the states are very slow to roll that out, and only $9 billion of the $49 billion has been allocated so far. So there's a lot of funds out there that we're glad to work with the borrowers if they'll meet us halfway and delay foreclosures, help keep them in their houses if they work with us. But they won't work with us, and as we like to say, pay, stay. You got to work with us, means halfway. We can be your best friend, but then if you won't work with us and tell us to go pound sand, hey, we're just going to kick the file to our attorneys and let them deal with it.
And that makes sense, right? Because you're giving them a chance to work with them. And I think that, this brings me to my next question, is that, let's say you take over this distressed property. Is it you, Scott, like your face, your name, that you're dealing with the borrower now? Or is it like your LLC and like a separate company that comes in and talks to the borrower?
Great question. I consider myself the general manager. Uh-huh. If you think of the Dallas Cowboys, which I'm a big fan of, I'm like the Jerry Jones. I'm not the guy down there, selling beers or flipping hot dogs to the stands or trying to coach, even though Jerry Jones wants to be the head coach. We all know that, right? Okay. I'm basically controlling and directing my vendors. It's a very vendor driven. So you should not be the investor talking to the borrowers. There's a lot of states that You need to have a debt collection license.
Yes. Okay.
Or be a debt buyer in a few situations. So there's servicing companies, like we have a third-party servicer who's handling most of the borrower outreach.
Uh-huh.
And then, when they talk to a borrower, they send us an email. We get on the phone, every 2 weeks. Hey, what's going on with our portfolio? What's going on with this lender or this borrower? And like I just got yesterday, I got an email in. Hey, the borrower wants to do this type of loan mod on their file. Do you approve it? I'm looking through the numbers. I'm like, yeah, let's do it. Let's approve it. They're bringing 5 months to the table. They're going to increase their payment from $400 to $500 a month to get caught up for the next 6 months. I'm cool keeping that person, that property in Indiana. It's a win-win across the board then.
Okay. How do you, so like, for example, like in the state of Texas, do you need a debt collection license?
No, Texas is one of the states that does not require you to have a debt collector's license.
Okay.
But you should, because you can screw stuff up. There's the Consumer Finance Protection Bureau, CFPB, that kind of governs personal debt like this. And you can screw stuff up. And honestly, most people have a great heart. Most people are really good. And they get this, I don't want to say sob story, but a story from the bars. Oh, I lost my job, or my grandmother passed away. I can't pay. And most investors will think with their heart versus thinking black and white with a bottom line.
Yeah.
And this is one thing we really kind of bang into our students out there. Like, listen, you are not the person that should be negotiating. You should have a third party that's there to do it. They can be cut through the black and white.
Yes.
Because otherwise you'll have bars like, oh, my grandmother for the 8th time has passed. You know what I mean?
Yeah.
Or they'll play you against the servicing company. Oh, you said this and that. So it's best just to step away, appear it from a black. That doesn't mean you can't help people. I mean, there's plenty of ways to help people, but you'll have people that will, oh, I can't pay this month. Well, and we see this every month that a mortgage is not paid. It really costs you an extra 8 to 10% of return on your investment because you're letting people slide for a month.
And this is why I think banks are successful, is because they thought of these, right? Banks are owned by humans, but they have these functions in place to take away, so that you can't really, tell your lender, hey, I'm having all these personal issues. It's like you have to pay, they have their system set up so that way it's corporately ran. That could be positive or negative in the business world, right? It could be good because things move accordingly. They're logical. They move in a systematic way. It could also be bad because there's really no room to work with people unless you want to, you have the leniency to work with people if you want to, which is like one of the advantages of doing this is like you can make up your own kind of standards of how you want to help people rather than relying on a board of telling you what to do. So I'm sensing there's really and correct me if I'm wrong, there's 2 ways to do this. Like one way is you could probably go through your courses, your podcasts, your training, learn how to do this, learn how to find the notes, invest in them, buy them, take care of them, go through the third-party servicers, or possibly even invest in somebody else that does this. And then you would just be like a limited partner. You would just be putting money into it. They would be going out, finding the notes, negotiating, talking to the third-party servicers. Am I right about that?
Yeah, there's basically, you have, if you want to do it yourself, a DIY or DFY is like we said, where if you want to learn how to do it, we teach people how to do it because there's thousands of banks and institutions out there. There's plenty of notes if you know where to look and how to look. That I can't reach them all. But then we also have we have a fund that we're finishing up on where people can invest passively, make a better return than a certificate of disappointment, or their 401k is now a 101k, and it's, stuff like that gives them a pretty decent return, versus what they not making or negative stuff. So yeah, we've got that aspect as well for people to invest passively, but it's always good. I think one of the most important things when it comes to investing, no matter what it is, whether it's notes or tiddlywinks or annuities or insurance, is you need to know the product.
Yes.
You know what I mean?
Yeah, sure.
That's one of the things that we started teaching, was just to help people understand the product, understand this asset class, because it's not the same thing as going out and buying an REO or a rental property.
Yeah.
You got to know all the ins and outs, and it's got some tips and turns, but it is such a niche that we are excited about for a couple of reasons. One, we see deals usually 12 to 24 months ahead of most real retail buyers or retail investors who are waiting for the foreclosure auction. We see deals before it ever hits the auction. Second thing is that it's no direct mail. We're not having to mail out postcards and yellow letters. We're dealing direct with banks and asset managers. So they send us lists on a regular basis. It's not one deal from one bar and that's it. It's 100, 300, 1,000 every month, every quarter, a year from these different banks. So it feeds us continuously. And the pricings, we're paying a lot better than what most people are paying. The market's hot out there. We're paying a substantial discount below what most people are paying at retail for it. So it gives us, those are the 3 biggest things that I love that are different that really help people, but it's ins and outs. I see people who've bought a note without understanding or just trying to learn from a podcast, and they end up losing because they overpaying or they miss out, they do something wrong.
Yes.
And I mean, that's anything. If you don't understand what you're doing, you're going to end up getting burned. And this isn't a hobby. This is buying debt. It's federal, CFPB and Dodd-Frank and other things you got to know about before you dive into the deep end.
Yeah, of course. I mean, you're dealing with sharks essentially. You're dealing with the banks, financial institutions, like the big boys. It's definitely something you need to be trained on. And back to like the thinking like a bank part. It's got me thinking, and I think you're kind of familiar with like Bank on Yourself and infinite banking, the use of like cash value whole life insurance. I'm just seeing this go together so nicely and so smoothly because like you have, for example, your whole life insurance policy, you're paying into it, you have the cash value building up. You come across these deals either as a passive investor in your fund or the do-it-yourself part, but either way, you could leverage the policy, borrow against that, use to invest in these notes, and then use the proceeds from the notes to pay back the loan. And then when you do that, you have two assets. You have your whole life policy compounding, and you have the interest earned from the notes and the profits from that. And then you kind of have them cycling together. Also, to kind of take it a step further, you have your cash value life insurance policy building and sheltered almost tax-free income, tax-free wealth there, plus protection from outside creditors and outside things like that. So really, you can kind of spin this around and do many things with it when you combine it with other investment opportunities like investing in notes.
Well, that's the beautiful thing is the fact that when somebody can invest in one of your policies and get the cash back in what is it, 30 days or something like that. Yeah, minus a little bit. That still gives you the flexibility to really kind of insure yourself. If you've got a $100,000 policy and $50,000 cash, pull that 50 out, go invest it, and making a double-digit return, or an 8 to 10% return on a performing note.
Yes.
And use it to leverage it. You've got the best of both worlds. That I totally agree with that, Sarah. Yeah, it's a great strategy, and I love it. I think it's one of the smartest things that most people need to know about because a couple of things. Lawsuit proof, you can't go after insurance policy for lawsuits and stuff like that. And it also kind of works as a key man policy if you're using other people's money for it as well. So if something happens to you, hey, the investor is paid back, and then your entity or your estate handles the asset after that.
Yeah, exactly. It's a good point. Yeah, it could be used for different types of different layers of protections. That's awesome. Now I want to talk more. I want to go back to about the COVID part. So do you see an uptick coming up in terms of foreclosures? In other words, do you see like that number increasing in the next few months because of the moratoriums coming to an end?
Yeah, I mean, don't get me wrong. The moratoriums have a love-hate relationship. I think it was good that the government did something to help so many people out. I totally agree. When things happen back, 2 Februarys ago, hey, this is a 90, 120 day, maybe longer thing to solve everything as everything shut down. That's fine. I didn't like the fact that they kept extending and kept extending. When we see such a huge amount of people out of work, but then so many job openings, something doesn't make sense there. If somebody wants to work, they need to be working. And we saw borrowers take advantage of that, say, oh, I'm not working. And then we would do some simple research on our end and find, oh, they've been working. They haven't stopped working.
Yeah.
You know what I mean? So yeah, we've seen an uptick in foreclosures across the country as each state has a different time frame. Seen an increase in foreclosures. We've seen a lot of what you're going to see mostly of is non-government backed loans. The government insured.
Yes.
Most of those lenders have just basically done a forbearance agreement and pushed out. Okay, your 30-year loan that you were in 27 years is now 28 years. We're just going to take that year of payments and put it on the face amount. That's fine. But what you are seeing more so in the market is our second homes, investor loans, non-government backed loans that are what's coming to foreclosure, as there's not the safety or the federal bailout, I guess you could say, on those types of loans. So
that's a good point. Yeah. I interviewed, I don't know if you know Sean Yester, who's an attorney, bankruptcy attorney. I interviewed him. He mentioned this.
I know Sean. Yes, Sean and I are good friends.
Oh,
Sean,
wow. Okay.
Breaking the Bank, I think is his podcast.
Crushing Debt Podcast.
Crushing Debt Podcast. Yeah, he's got a book. I got his book sitting around here somewhere. Actually, I gave it to a friend of mine yesterday. Sean's a great guy, and Sean's got such a great because he's been on both sides of the equation before. Yeah.
Yeah, that's awesome. Small world. Yeah, he mentioned that. Yeah, if like for example, if you own, if you're living in a home that's being backed by like a hard money lender or private money lender, it's not going to have the same protection as it would if it was a federally backed loan. Yeah, that's awesome.
Yeah, he knows his stuff, man.
Yeah. Yeah. So what else? Yeah.
So that leads to opportunities.
Yeah.
That's opportunity. So like that's where we come in, and those type of lenders or those banks that have that, they're looking to move that stuff because they may not necessarily want to own the asset.
Yes.
And so hard money lenders usually have a higher interest rate of 12% or so.
Yeah.
So they're not usually taking a big discount. They're usually only at 70% of value at the greatest or less. So they've got all this equity. We've bought hard money loans from a lender before and worked them out. What you have to realize, if you're a borrower that's facing that, the best thing you can do is contact your bank early.
Yes.
Contact it and share what's going on and go from there. This doesn't mean call me to buy your note. There are specific, I get that happen all the time. Oh, can you call my bank and buy my note and just let me be into it? I'm like, well, I'm out to make a profit. I'm not just going to let you stay for free. I donate to charities. But that's the thing is, we're not buying from Bank of America, Chase, Citi, Wells Fargo. Those big guys, those top 5 or 10, they're selling stuff in $50 million portfolios.
Yeah.
And they're not taking a big discount. We see the biggest bang for the buck on that sub $200,000 valued house, that second home, that investor home. I hate to say it, but it's the landlords, the small mom and pop landlords have been hit very hard because the loans aren't insured, and then many of them were trying to survive on that profit between what they paid on their mortgage and the rent rates.
Okay.
And that dried up for them. So if you're going to find yourself in a situation, talk to your lender. Don't let it go to foreclosure. It makes more sense for you, especially if you've got late pays, just to deed the property back to your lender and walk away and start afresh again. Or maybe even be able to negotiate, just have them remove the bad hiccups on your credit and just deed the property over in a friendly foreclosure in a lot of cases, and then rebuild or cash out. If you've got equity, sell the property if it's in a market that's selling like fast. The worst thing that most people do is it's inaction, and somebody makes a decision for you, and it's usually not the right decision.
Yeah, I think the worst thing is just avoiding the lender, avoiding all communication, and then just waiting until like it's just too late to do anything. That's probably the worst thing.
Yeah, exactly. That's the thing. I mean, talk with the borrower. I mean, one of the things that's very beneficial is that with these programs that have been rolled out, find out what's going on in your state. I mean, Texas, I'll give you a great. Texas has a $1 billion rental assistance fund. $1 billion.
Wow.
And so if you've got renters that aren't paying, it pays for you to figure that out. Download the paperwork, go fill it out, incentivize them.
Yes.
Hey, just try to do that, because a lot of the lenders, and we don't want to be bad guys. I mean, there's been people like, listen, I understand what's going on. That's fine. But you got to do something. If we don't have any action from you in the next 30 or 60 days, we're going to take the action, and you're not going to like it most of the time.
Exactly. Yeah. So kind of just to recap, what do you do to help people in this niche?
So are you talking borrowers? Or are you talking investors? Which way do you want to go?
Anyway, so in other words, if I were to reach out to you, what could you potentially help with as far as?
We deal with a lot of investors who come from the fix and flip side, who can't find deals, or their landlords who are worn out and exhausted from dealing with toilets, tenants, and trash outs. They would rather be the bank, because nobody calls the bank when little Timmy's rubber ducky gets flushed down the toilet at 2 a.m. or the air conditioner stops working. You know what I mean? Nobody calls the bank. And that's a beautiful thing. And another thing is, you can do this business from anywhere. So a lot of people like to invest in their own backyard. And I'm like, I live in Austin. It's one of the hottest markets in the country. I haven't bought anything here in over a decade because I found better deals elsewhere. So the beautiful thing is, you've got internet and phone and are coachable. You can do this business from anywhere, and you're not just relegated to your backyard or state. And it's also the starting out of it is a lot cheaper than most other tactics, because you're not having to come up with rehab costs. We're using 95% usually other people's money to take these deals down, and leveraging retirement accounts and stuff like that. So that helps. That's the facet. As far as the borrower side, if we're buying a note and we're reaching out to them, hey, we want them to stay in the house. That's our actually number one strategy, is try to keep them in their houses. But it's got to make sense. If they can only afford $800 a month, but the market rent of the property is $1,200 and their mortgage payment is more than the $800, sometimes you got to have that conversation. Like, listen, I get it. You've been through a financial hiccup. Let's get you out, get your reset. Let's take away this big albatross over you, or this big nightmare, and turn turn it back into a dream of homeownership versus Freddy Krueger stalking you when you're upside down. You're worried about, you don't want to meet the mailman face to face with another certified letter, or hear the court proceedings. So we like to help people out. I mean, I've got people that we modified their loan, they've been paying on for 3-4 years, and it's
Okay.
it's a good day. It's, or settling their debt at a big discount, so it's a win-win. That's always a highlight of it. But the biggest thing, and I know that this is something that's very impactful to you, is really seeing people accomplish things or take a step forward toward their dreams, whether it's retirement or paying off their debt or retiring their spouse or saying, hey, boss, take this job and shove it. I'm doing well on my own. That's the biggest impact that we make, I think, is helping entrepreneurs really identify a niche that's out there. It's a niche within a niche. It does take some work, but it can be very valuable without all the heavy costs of rehab, overhead of fix and flipping, and a lot more. I like to say rewarding in a lot of ways, and helping neighborhoods survive and retain value in neighborhoods versus a foreclosure.
Okay, that makes sense. Yeah, I mean, it's good. Yeah, ultimately, this is a business that you could start, and I think the only cost you'll need, and correct me if I'm wrong, it's really more of the marketing parts. The phone, internet, the ability to communicate with people, the time needed to put into it, similar to other types of professional services.
Yep.
Where you don't need actual physical, but you could have a physical office if you wanted to, but it's not probably needed in the beginning. But yeah,
you don't even need to do that. I mean, I've had an office before, which is great, but for the last 2 years, I've worked from home.
Yeah.
Prior to that, I was traveling the country basically nonstop, working from hotels or traveling on vacation and working wherever I had internet service. So most of our students start off part-time. They're doing it from 7 p.m. to 2 a.m. or on the weekends. They don't have to do it 9 to 5 because they've got a normal career. So,
got it. Okay, that makes sense. And Scott, how can listeners connect with you and learn more about you?
It's really easy. If you go to our main website, weclosenotes.com. That's weclosenotes.com. Pretty simple.
Yeah.
Check out the podcast, The Note Close Show. I would love to give your audience a gift, though, if they're interested.
Please. Yeah.
We have a one-day class that we teach usually every month called Note Weekend. If you go to noteweekend.com and enter the code SARRY, SARRY, all caps, it will give you that one-day class for free. It's a $49 class, usually with over $1,000 in bonuses. You can get it for free by using the code SARRY, and you'll get it for free.
Oh, awesome. Thank you for that. I'll include those instructions in the show notes below, so that way you can just click and go to that, both of your websites. Yeah. Awesome, Scott. Well, thank you so much, man. I really enjoyed our conversation, and I look forward to having you back on the show.
Hey, man, it's a small world. You know what I mean? Gets smaller every day, and honored to be here as well with you, man. Looking forward to have you on my show as well soon here in the near future.
Thank you. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.